we hire for intellect. And in a conversation I had with Hannah at the time, she said, I've never made an investment. And I said, that actually doesn't matter to me because I can't teach somebody how to, run growth ops within three unicorns, but I can certainly teach somebody how to be a good investor in my eyes. And so I think understanding what actually matters is really important. And I think intellect matters. I think temperament matters. You've got to be fit for purpose for what you're doing, and you've got to hire people who are fit for purpose for what they're doing.
Hi everyone, welcome to episode 152 of the Startup Playbook podcast. I'm your host, Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, strategies they use to succeed, and their advice to current and future entrepreneurs. I'm delighted to have Alister Coleman, the co-founder and managing partner at Folklore Ventures, as my guest for this episode. Al started his career in portfolio management and banking for family offices before going on to become the co-founder of ShippingEasy in 2011, which was later acquired by Stamps.com for $80 million. He is now the co-founder and managing partner at Folklore Ventures, which is a $55 million pre-seed and seed stage venture capital fund in Australia. In this interview, we covered a wide range of topics, including lessons from Al's journey with ShippingEasy, including why selling too early is not a great outcome for founders and investors, Folklore's unique investment approach, which has led to a portfolio with next to no overlap with other VC funds in Australia, a look into Folklore's thorough due diligence process, Alister and Folklore's vision and approach to building a multi-generation fund, and much more. Without further ado, here is my interview with Alister Coleman. Hi, Al. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Thanks for having me. It's great to see you.
Likewise. Very excited for this episode. But Al, for those people that may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
Yeah. So started my career in portfolio management and banking for family offices that made .com investments, and they weren't the best investments, but it was really interesting track record to be able to follow, and then had to kind of work out what to do with those investments in a time that was really pretty ordinary for startups back in early 2000s. And then I managed mergers and acquisitions and strategy for a media company, large media company in Australia, for everything outside of their digital investments. And then became a founder of a SaaS company, which did pretty well. And that was moved overseas and sold a few years later. And then in the intervening time, I had always been investing and loved investment, and decided to found Tempest Partners, which we rebranded to Folklore this year.
Yeah. And obviously so much of your journey that I want to dive into as well, but you've obviously had, as you sort of just touched on, a really interesting journey of kind of starting in investments, moving into being a founder yourself, and then jumping back into investments as well. Just, I guess, going back to your founding experience, what was that like in terms of deciding to launch ShippingEasy? And I guess, what were some of the lessons that you took from your investing background that you sort of applied to the company?
Yeah, it was interesting because I didn't anticipate being on the operating side, and met Mark, who was just a brilliant product person, had just left Yahoo to basically build ShippingEasy, and he had a core thesis or a core idea about what he wanted to do, and we met each other and managed to sort of work through a better alternative, which was to, rather than power, courier, comparison and booking, actually turn it into an engine room for the long tail of SaaS e-commerce merchants to automate their fulfillment online. And so we spent a couple of years building that company, made all the mistakes that you would normally make. But as you know, product is always a thing in evolution. And we saw the opportunity to actually push into the US and go after a much bigger customer base, and also a much more valuable customer than I think we initially anticipated. And then as we were building the business and we decided on moving to the US, I think the question was, were we the right people to run that business? And, at the time, I didn't feel like I was a natural born operator. And I think Mark was very ensconced in the product. And so we felt like putting somebody in place to build the company after we moved it was the right decision. And that CEO, up until recently, still ran the company, and that's 8 years since we started it, 9 years since we started it. So a long journey for that business. But, the number one thing was that, we had to, I had an investor hat on the whole way, and really just sort of saw it as a project to try and block and tackle all of the issues that the company was going to need to face. And so, I raised its first seed round and put a fair bit of money into that as well. And so those investors also got a great return, but the lessons you learn from having, two people and a pretty good idea and a small office and trying to turn it into something are lessons that you can't learn anywhere else.
Yeah, absolutely. I think it's really fascinating that you mentioned that you never really sort of saw yourself being on the other side of the table as an operator as well. And, I'm sure that many people listening to the podcast that are thinking about launching a startup for the first time have multiple different ideas. And I think particularly as someone who was an investor as well, you would have seen so many different opportunities and great ideas potentially in front of you. What was it specifically about ShippingEasy that made you want to, I guess, take that plunge and feel like it was the right opportunity at the right time?
In 2009, 2010, I'd stepped out of sort of paid work, and in 2009 actually, and so I'd gone off to work for myself, and I had my first business, and I really, which was an investment and advisory business, and I really wanted to sort of expand that, but there was a huge question back then, 10, 11, 12 years ago, about how e-commerce was going to play out, and the conventional wisdom was that e-commerce was really going to play out at a product level by facilitating the existing retail base to go online, as opposed to creating a vast volume of new businesses. And I'd met one of the co-founders of Shopify online and just was talking to him about the way they saw the world. And obviously Shopify was always going to be a long tail e-commerce play. And at that point in time, payments, marketing, merchandising, building a site, building a store had all been effectively commoditized. And the one thing that hadn't been commoditized was, how do you actually ship something to somebody in a way that is automated and you can do that 100 times over in a day? And that wasn't evident to anybody. And it was just a very, very clear opportunity to me. I think I saw the opportunity. I think Mark certainly saw the opportunity. But you had to, we're talking about a time when you still had to send faxes to the courier companies in order to get an account. And so actually building APIs and connecting those APIs was really difficult, doing it in the US at a different scale and dealing with all the rigmarole around, the US Postal Service, which is, a government entity, and trying to get, a business model built around that was also very difficult. And I think that's why a lot of people had tried and not succeeded. And one of the reasons why when we adopted this long tail retail first strategy to provide full automation around fulfillment, at the time it just worked. And the customer growth was really quite strong in Australia, but when we decided to move the company to the US, it was almost a new start to the company. I mean, we had customers that sort of evidently were signals of what a good customer base would be. But we had to go and build it, and then we had to adapt the product and make that more efficient and more effective for retailers who are of a larger scale than we anticipated. So it's terrific lessons about how do you identify an opportunity and be patient to identify that opportunity. And ultimately there's a lot of biases, sort of survivorship biases around everything that always went right. And people don't really share the stories about what went wrong, but so much goes wrong for so many people. And, a lot of it comes down to picking the right people to work with, and ultimately, the timing of how you want to deploy, your idea into the market.
Yeah, absolutely. As you mentioned, there's, obviously so much of survivor bias, and especially, a lot of the stories that are kind of told through press are often sort of glossed over some of the more challenging components. And I think, running a startup is often such a roller coaster as well, both in terms of emotions and just kind of challenges that startups have to go through. What are some of the, I guess, less expected challenges or kind of problems that you faced in building ShippingEasy that maybe weren't as evident when you first got started?
Well, it comes back to picking the right people. And, we started the company before there was a venture capital industry or sort of venture capital 2.0 in Australia. And so you really had to try and work out where you were going to get the capital from. And that was something that was very difficult because, we had this hangover of what I would sort of call 90s style behavior, or, very much putting the investors first and putting the founders second. And I think that if we had started to build the company a couple of years later, firstly, we probably would have been beaten, but secondly, we wouldn't have probably had to have dealt with some of the challenges we faced around, those questions about who do you build those companies with and who do you take capital from. And coming out of that was really the gestation for what I wanted to do, why I wanted to start this firm, because it didn't make sense to me that the people who were creating the value were put secondary to the people who were providing the funding. And it still doesn't make sense to me. And so, we had, speaking very frankly, we had difficult challenges in trying to keep investors focused on the long game. And we sold the company for a lot of money, but we could have sold the company for a hell of a lot of money. If the investors had been patient, and if we'd had more patience around building the company and the pitfalls and the journey that every startup has to go on. And so those lessons are the lessons that we've taken into Folklore, which is that these aren't smooth rides punctuated by, press releases that go out and high-fiving around raising capital. These are really bumpy rides, and investors need to be patient, and they need to be conscious of the people that they're picking and why they've picked them to work with, but to allow the founders to develop and actually build a company.
Yeah, just digging into that a little bit deeper. I know from having multiple conversations with early stage startups, and even through some of my own background as well, at the very early stages, it's just so hard to convince anyone to get around you, that oftentimes advisors or people wanting to get involved, it just seems like a real blessing. And I see a lot of non-technical founders kind of bring on the first technical person that says that they want to kind of help them build a product, in terms of bring them on board as a technical co-founder. But as you mentioned, having the right people around you is really, really important. Do you have any advice for founders that are potentially at that stage, in terms of understanding what are some of the markers, or what are some of the filtering processes, or what's the process that they should go through to help make sure that they're both aligned and also bringing the right people on board, either from an advisory or from a team perspective?
Yeah, so I think that's an interesting question, because a lot of the time people look for what they try and find what they're looking for in other people and not necessarily themselves. So I think a great place for a founder to start with is to understand what actually grinds their gears. What are the things that they find frustrating? Understand what your weaknesses are. Understand where you want to go as a founder, or where you want to go as a professional, and try and get a true sense for what you think your personal journey is. And then try and work out who that's going to be compatible with. Because, if you're the founder of a company, if you've decided to go and build something, people are coming to work with you. You're not going to work with people. So it's very hard. And I would argue that it's not actually a positive outcome for the companies if a founder leaves. So I think the challenge here is that people actually have to understand themselves before they want to try and understand who's going to work with them. From that point on, you can start to determine the type of mix you want around you, and the type of talent you want around you, and how to motivate those people, and how to communicate who you are to those people, so that when they join, there isn't a disconnect between who you are and what they're going to experience. Building companies is tough, right? So everybody who tries to build a company goes through a journey where they change, and there's a lot of stress involved. And so it really helps people to understand who you are when you're trying to get them on board, and what your mission is and what your goals are. I think that is a much stronger starting point than simply saying, I've got to fill this box with this type of person, and then finding out 6 months later that, you didn't realize that they were, not a great fit for you as a founder of an early stage company.
Absolutely. Great advice. And just going onto the point that you mentioned in terms of the acquisition of ShippingEasy as well, which was acquired by stamps.com for 80 million, I believe.
Yeah, about that. Yeah.
Yeah.
80 million Aussie. Yeah.
Yeah. I've had Nick Crocker from Blackbird on the podcast a few times. And one of the things that he mentioned was some of the acquisition process that he went through with a couple of his companies that sold to Twitter and MyFitnessPal. And just, I guess with hindsight, just reassessing kind of some of those decisions. And, I think you kind of touched on something similar as well. And again, oftentimes it can be a really difficult decision-making process for a founder at that particular stage in terms of understanding what the right pathway is. Obviously when you're provided this great multi-million-dollar offer on the table, and you have an opportunity to provide great returns for your investors and everyone that's kind of supported you up to that point, it can be very tempting. But potentially again, some factors that need to be discussed. For portfolio companies or any other founders that are in that fortunate position where they do have those sort of things, do you have any advice in terms of how founders should assess or kind of think about whether it's the right decision for them or not?
Yeah, well, firstly, the frame I would put to it is selling too early is not good for your investors. And so, whilst getting some money back is great for people, selling too early and missing out on the true opportunity is actually not in people's best interests. And there really does need to be some boldness to the decision. A lot of founders get 7, 8, 9, 10 years into a journey and they're pretty tired. And you can understand why people who have an opportunity to crystallize some value that they've created actually choose to sell those companies. And I actually really empathize with founders who, go through a lot personally and go through a lot professionally in order to create some value. And they just want to see that company go off to its next step. And so I think, it's important to just understand your motivations. I think a lot of founders, unfortunately, are pushed into exits, and I think that's many instances doing everybody a disservice. For instance, I think in ShippingEasy's case, had we been more patient and actually tried to build a company of real long-term value, it actually would have been worth a hell of a lot more, as I said. But the piece here is to make sure that you've got great alignment with your investors about what the journey will be, that it could be long, that you're trying to build something of value. Most founders, are trying to do something for the investors and themselves and their customers. And people need to understand that that's the perspective that people start companies. They don't necessarily start companies just to make money. And in fact, our preference is to not invest in founders whose sole driver is to make some money out of it. And we prefer to see people, really catalyze the effort of both their effort and their team's effort over time, and to do that patiently and to not rush to the exit door, because you never really know what the opportunity ahead might look like, and you might only get one shot at it. Some people have one great idea in their life, and if they cash out too early, they'll never see that truly play out. And you never know how many customers you might help. You never know how many staff you might have brought on that might have created life-changing opportunity for them as well. And so, selling too early is not a great thing.
Yeah, absolutely. And, it's interesting that you kind of mentioned the sort of long-term view from the investment side as well. I think in one of our previous conversations, something that really struck out to me was you mentioning, really from the early days of, Tempest and our Folklore, of kind of thinking about it from a multi-generational perspective of a fund, which I think is just such a fascinating view to kind of take so early on from a fund perspective as well, in terms of the structure and the people that you've put around you. Can you share some of the thinking behind that, and I guess why that's been such a sort of core pillar in terms of how you've thought about building the fund itself?
Yeah, it's sure. So most VC funds are really just partnerships with trust sitting on top of them, and when income starts to flow out of those funds and the performance of those funds, there's very little real incentive for the partners to reinvest and grow the firm. And so what you typically see is really difficult succession issues with venture capital firms as partners have started to do well. And we didn't set the firm up that way. We set it up as a company so that we could share the gains with everybody from the outset, and bring people in and around the firm that we felt could provide us with long-term stewardship over our decision making. And I don't see this as a 1, 2, or 3 fund journey. I see this as a multi-decade journey, and every fund that we raise has 10 years lifespan to it. And it's surprising. It surprises me often when I talk to people who aspire to be VCs, how they don't fundamentally comprehend that they actually have to manage that capital for a decade, and that there isn't really a lot of flexibility if you want to be honest with your investors about what your plans are. So I've always had a very long-term view about life, which is, if you're going to start to do something new, it's going to be 5 years before you can do that relatively well. And so everything is always, to me, 5 years down the track. The person that I want to be running a venture capital firm is probably 5 years away. And so improvement takes time. And so I've always had that view. And I think, great returns are developed over time. And ultimately, if you're going to build something that's impactful and meaningful, and we hope we're building one of the great investment firms, that you have a long-term view and you don't put yourself in situations where you can't, see the full extent of the value that you want to create play itself out. And so we built a company, and we treat it like a company. And about 5 years ago, I asked the CEO of Magellan to join our board, because Magellan is one of the fastest growing active investment management firms in the world. It's $120 billion under management, and probably underestimated in its ability and its impact. And so Brett Cairns, who's the CEO, joined the board about 4 years ago, and he's been fantastic to help steward this, this multi-generational, multi-decade view about how to build something durable. And that's what we work on day in, day out. It's not just the investments, but it's actually building a firm.
Yeah, absolutely. And, having that long-term view is often, helps make really good decisions. But, oftentimes it's really difficult kind of in the day-to-day, both from a founder perspective, or if you're building a company, or really doing anything at all. One sentence kind of really stood out to me from a blog post that you wrote a little while ago was, as humans, we find it very difficult to look beyond short-term factors in periods of immense stress. And, I think being a startup founder is one of the most stressful things that you can do to take on.
Yeah.
Do you have any frameworks or any advice that you have in terms of how you make decisions yourself from a Folklore perspective that founders should potentially be enabling into their own process to help them make better decisions and having a more sort of long-term view?
Well, I think it's normal to make bad decisions when you are stressed, and when you're under duress. And the reason why we do that is deep in our brains. We've got a flight or fight trigger, and so a lot of chemicals kick in to help us deal with periods of stress by dealing with factors that are in front of us, rather than saying, I'm hyper stressed and I need to be thinking 5 years ahead, and that's really very, very difficult. So having good people around you, I think, is important. We have a board, and I would recommend to every founder that they have a board of people who are trusted, that can bring them out of their day-to-day and help them think about the world around them and where they're going, and just recenter them. I think it's important that you work with people who have, I've always thought you hire for intellect. You don't just hire for skills and experience. You actually have to hire for intellect. And it's the people around you that you've hired, that you trust, who can, help you manage the difficult periods effectively, because not everything in a business is typically stressed. There are, typically one or two factors that are screaming loudly, but the balance of those other factors within the business are normally pretty good. So just having that perspective from the people around you is really important. And then, simple tricks. Don't make important decisions rashly. Take your time. Don't send important emails quickly. Give yourself the opportunity to have some sleep if you can, because a lot of founders don't sleep that well. And, having founded 3 businesses, I know what that feels like. And, you just want to make sure that you're, you have a clear frame of mind when you're acting on important matters. And then, making sure that you have a high degree of care for the people around you, and the team also helps it. That will come back to you when you're stressed as well, and when you're under the pump, because just as you might overtly look after people's best interests and their well-being, you'll find that will come back in spades when things aren't going as well.
Absolutely. And, speaking of kind of surrounding yourself with the right people as well, one of the people that I got to speak to as part of the research process for this interview was Hannah Field, who is one of the partners at Folklore as well. Yeah. And one of the things that she was talking to me about was, her own journey into VC as well. And obviously just her incredibly unique background that she's had. But she mentioned that, when she was exploring joining the investing side or joining the venture capital world, it was very difficult for other funds that she was speaking to define what her role should be or where to kind of put her, because she didn't really come from a traditional background that you would sort of normally expect from someone in the VC landscape. But she mentioned that, pretty early on, you kind of had conviction, and you had really strong conviction around her. And I think for her, she said, like, one of your sort of superpowers is just really sort of understanding or kind of identifying sort of diamonds in the rough, but from an investment perspective, but also from a team perspective as well. And those skills are obviously really hard when you don't have a huge amount of data points around you. So again, like really curious to sort of understand either from an investing perspective or from a hiring process, what are things that you sort of look for? Like what are the key markers that sort of help build that conviction in people to either invest or to bring them onto the Folklore team?
Yeah, that's a really interesting question because, as I just said that, we hire for intellect, and in a conversation I had with Hannah at the time, she said, I've never made an investment. And I said, that actually doesn't matter to me because I can't teach somebody how to, run growth ops within 3 unicorns, but I can certainly teach somebody how to be a good investor in my eyes. And so I think understanding what actually matters is really important. And I think intellect matters. I think temperament matters. You've got to be fit for purpose for what you're doing, and you've got to hire people who are fit for purpose for what they're doing. And we're in the business of meeting people, and this year we might look at 850, 900 companies. There might be 1,800 founders in that group. There might be 1,600 founders in that group, and so I'm not doing all of those meetings, but I've done my fair share of meeting talented people. And again, coming back to this point about sort of understanding yourself and understanding, how you work, and the right type of people for you, and bringing the right sort of people in and around you that can challenge you, and also complement the vision that you have and the mission that you're on. And so, I think I've developed a pretty good barometer for the types of people that we meet, and am a pretty quick steer on people now. And of course, you always get, you're always getting it wrong, but you're getting it wrong in smaller degrees of variance. And so it was clear to me that we should hire Hannah probably 15 minutes into meeting. And the other factor that she brought on board was this track record she's had in building teams. And every founder is in the game of building teams, and that's almost their primary goal, is to build the right team. And I had done that in some respects, but I hadn't done it at the scale and the speed in which she'd done it. And I felt like she could really help a lot of companies and really make a big impact. And so that was, they were the factors driving our decision to see if Hannah would join. And I think the big mistake that a lot of firms make is that they fundamentally don't understand the power of diversity in teams. A lot of companies want to hire people like them, and that over time, can lead you in the right direction if you constantly make good decisions. But if you're even slightly off in the wrong direction, it'll just compound that effect. And so I think that it's important to understand that you don't have all the answers, and you need to bring people in who do have answers, and they need to come from different backgrounds to yourself.
And that kind of search for answers is a really sort of interesting thread that I want to pull on as well. I think one of the really interesting things of kind of seeing the evolution of Tempest and our Folklore has been, a focus in health tech in particular, which from what I understand wasn't, isn't the only sort of mandate that you have, but definitely wasn't a kind of core part of the mandate when you sort of first started the fund as well, but definitely came from, to my understanding, just speaking to founders and sort of looking at opportunities as well in the market. But can you kind of just, again, from a founder perspective, I think it's just really interesting to sort of understand how to understand different opportunities that exist in the market as well. What did that sort of evolution or process look like from a Folklore perspective in sort of identifying and then sort of acting on that opportunity in health tech?
Yeah, well, I mean, the first thing to sort of pick out there is that there isn't a right answer. This is not mathematics, and so we I think VCs, because they're ultimately managing other people's money, make a few fundamental errors. The first one is that they believe that they're somehow superior or superhuman in some way, and they have special powers. And really, I think that people need to remember that they're essentially, venture capital is essentially a middleware product between investors and founders, and you just have to be very, very good at being middleware. And there isn't any right answer. So the journey that you're on as an investor is you are piloting some decision making through really uncharted waters and really uncharted territory, and where you think you're starting from is not always the place that you are, and where you're going is not always the place that you end up. And And so I think, we talked about survivorship bias, and confirmation bias is obviously another failing that pretty much everybody has. I have it in spades, and so does everybody else. But the number one thing is to understand that you need to be open-minded. And when we approach investment, we don't know where the secrets are coming from. And so we need to be open-minded. And we've talked for almost a decade about being sector agnostic, even before it was sort of fashionable to say that you were. And that's partly because we don't know if the next amazing founder is walking in the door today or tomorrow. But we need to be open-minded that they will. And we need to be open-minded about how founders see their vision, and whether we can see that with them. And then we get to the question of where are we going? And so we've made 5 health tech investments, and I think we'll make another one pretty soon. And that's really been brought on by just a continuous exploration of an ecosystem and an industry that we've had to learn over time. We didn't invest in the first health tech company we saw. We would have looked at 100 companies before we made our first investment into Health Match. And we've probably looked at 400 or 500 companies since then to add another four companies on top. So it takes time to do these things, but we also gravitate towards companies and industries where we think that our own activities and the capital of our investors will have a big impact. And if you have a powerful mission and you can have a big impact, you will attract capital, and you will attract customers, and you will attract amazing talent. And I'm not passing a aspersion on the character of people who work in restaurant booking software, but if you put a restaurant booking engineering role paying a certain amount of money in front of somebody, and then you put a role at a Health Match paying the same amount of money, and you say, well, fundamentally, do you want to help people get bookings at restaurants, or do you want to save people's lives? You will get a group of very talented people seeking the opportunity to help save people's lives. And so health tech's got those powers, and I think robotics and automation and computer vision have those powers over the longer term. We are obsessed by data network effects. I think a lot of VCs have invested in companies that have powerful data network effects, but we've got a company in New Zealand called Aura, which is just phenomenal. And its long-term impact is that it helps retailers and crime forces, or police forces, solve sophisticated and organized crime. And overwhelmingly, lower socioeconomic groups tend to end up in prisons and in the correctional system because they're less sophisticated at conducting crime, and they commit opportunistic theft. But it's actually not where the majority of the value and the majority of the impact is felt on community. It actually, 85% of all crime that has a true impact is sophisticated and organized. And so, if we can invest in companies that focus the attention of, in that case, law enforcement on what matters, and give communities other ways of rehabilitating people that made one mistake in their life and, unfortunately ended up in jail, or hopefully made one mistake in their lives and didn't make another one and then didn't go to jail. I think it's really powerful. And so I think that, we've just continued to look for big missions and things that matter. And we're not an impact investment firm, but if we can, back great founders and the byproduct of them building a company is a positive impact, then that's even better. That makes it even more worthwhile.
Absolutely. Absolutely. Just picking up on one of the things that you mentioned a little bit earlier, which was, especially in the world of VC or investing, it is a long-term game, and it's, that there is no right answer as well. Yeah. And one of the things that I was really astounded by when I found out was that, Folklore doesn't have a huge amount of overlap with other VC funds in Australia, which is actually quite rare for the Australian market as well, with such a relatively small VC community. First of all, can you share a little bit in terms of, I guess, your investing approach, particularly in terms of that, but also, because there is such a long, feedback loop in terms of sort of understanding kind of different approaches, how do you personally just make sure, what are the indicators that you're looking for that the type of investments that you're making or the type of approach and strategy that you have is the right one?
Yeah, so the our investment approach is something that has developed over 14 years. So I actually developed that when I was in a corporate role to help management teams make better decisions around the investments that they were going to make. And then I morphed that into my own personal purposes. And then we morphed that into what Folklore currently uses. I think that there is a tendency to believe that a company that's receiving more and more investment is becoming less and less de-risked and more likely to succeed over the longer term. And the data certainly indicates that that's not necessarily the case. A lot more companies die of indigestion and starvation once they start to receive venture capital. So I think that we have a habit in Australia of anchoring towards capital raises rather than revenue and customers served, I think, over time, and the quality of people and the quality of missions, and not to downplay the importance of companies in other people's portfolios, because ultimately founders are building those companies and that's their life's work. But we just tend to not have overlap between other VCs, yet we tend to have very strong performance on global benchmarks. And I think that comes back to durability of the companies that we have in our portfolio. We are investing at seed, pre-seed, as early as we possibly can, yet we have very low failure rates across our portfolio. And that investment process is anchored in, I'll just explain it quickly, it's a people, product, opportunity, context, and investment term framework. And so we break our decision-making into 5 factors, 5 components, and then we walk through that process in a really diligent way. And we track over that process, we track how our entire investment team is looking at our particular companies. And that can be over a 3-week period, or it can be over a 9-month period as we're getting to know a company that hasn't yet raised a round. And by the end of that process, we tend to know exactly why we've invested in that company. And if we can put 20 or 30 or $50 million into a company, that would be amazing if a current company warranted that much investment from us. But I don't think it's sensible in some respects, or realistic, to believe that later stage investment is de-risked, just because it's later. I don't think it's de-risked putting, $10 million, $20 million into a company as the first investment on 6 weeks DD, when you can, put $10, $20 million into a company on 5 years DD, once you've started to get to know it from a very early stage. And so we prefer to understand why we went into a company to balance our investment, and then build our position over time and support founders over the longer term. And by the time we're allocating significant amount of capital, we really understand that company and where it's going. And the trick then is, are we being honest with ourselves and realistic about its prospects, and is it a good place for the capital of our investors? But I think that its process has really been road tested a lot, and it's important to stick to a process and make fine tuning to it rather than big changes, because the feedback loop on venture capital investment can be so long that you really don't know for quite a few years whether the changes you made a few years earlier were the right ones. So it's important to treat this type of activity as a discipline, and treat it professionally, and really be introspective about the decisions you're making and why.
Absolutely. One of the other people that I got to speak to in doing research for this interview is one of your portfolio founders, Eric Peck from Superhero.
Okay. Great.
And one of the things that he spoke about was the thoroughness of the due diligence process for Folklore. And one of the things that he even mentioned was, the thoroughness of this, and being offered a term sheet by Folklore is usually a great signal to the market that the business is quite legitimate as well. Is there anything that you can sort of share in terms of what that due diligence process looks like from your perspective, especially for maybe relatively early stage companies that you're thinking about backing for the first time?
Yeah, I mean, it's thorough, and VC is a game of speed as well. So we're not always going to be able to make an investment because we're going to miss some investments because we want to know exactly why we backed a founder, and we don't want to be in a situation. Certainly don't want to have our founders in a situation where we ask what the hell the company's doing at the second board meeting, or the second time it provides an update. We don't want to be in those situations, and we don't think it's good for the founders. We don't think it's good for us or our investors. And so our investment process, as I said, or our due diligence really does start with the investment process and collecting information and insight and really observing what we think is present in that founding team and why we think that they'll have a unique competitive advantage, or at least a better than average shot at succeeding. And for instance, when we met Swoop, the company was told that what they were trying to do was impossible. And I think that, I personally love companies that, people say, oh, you can't do that, that's impossible, because pretty much everything that we do right now is impossible at some point in time. Like what we're doing, you and I right now, was impossible 20 years ago. And so it's so I love those opportunities. And for Swoop's case, Eric was told that he couldn't fly, he couldn't carry a heavy payload over long distances autonomously with, a long range drone. Couldn't do it outside radio or 3G range. Certainly couldn't do it legally. He couldn't do it within the confines of the regulations. And he was also told that he wasn't building a global company. And he was told that by a pretty well-known VC. And we stayed in touch with him, and we just started to learn about the very, very complex technological stack that's required to safely operate drones globally. And it was quite clear that what he was doing wasn't impossible. It just required time, and it required smart people. And he, I think they had a strategy night last Friday night, and they presented that the company had done 5,700 flights just in the last 12 months. And so it's not that impossible. And it just took some time, and their first contract was in Vanuatu, so it wasn't even an Australian contract. And so, I think that perceptions and views are always up for challenge, and the best people to challenge them are founders.
Absolutely. I think Eric was also telling me about a story when I think you were about to offer him a term sheet, and he said, we actually have to go to Vanuatu and we won't have kind of time to complete this process. So we'll come back and let you know when we're actually going to complete the raise. Is that true?
Yeah, and we talked 3 or 4 times whilst I was in Vanuatu, and and we were just, we basically said, well, when you're ready, we're ready. And I think that there's some bizarre games played by some investors where they say that if they don't get an answer, if they don't get the answer that they like within a given time frame, they're going to walk. And I find that bizarre, because good companies and great opportunities don't come along that often to be temperamental and putting a gun to founders' heads about getting what you want when you want it. Ultimately, as I said, the capital's for the founders and for the investors, and so we were very patient in that process, as patient as Eric was in allowing us to learn what he innately saw. And that's part of the journey. And we're very, very proud of being investors in that company, and the impact it's had is huge. I mean, it's flying COVID vaccines in New Zealand and the UK, Scotland. It's flown vaccines, Ebola vaccines in Africa. It's made a huge impact on people, and it's a really outstanding company. And they will have hundreds and hundreds of drones flying all over the world in their coming year, and that's something really exciting to be a part of, and I think also something very valuable. I mean, the idea that a Hyundai i30 with an Esky in the back of it is the bleeding edge of advanced technology to carry pharmaceuticals, pathology, and pharmacology around distances is just something I just don't believe anymore. That there is a faster, better, safer way to do that, and one that's more effective for people, both in greater metropolitan and also remote and distance areas.
Well, one other thing that Eric mentioned to me in terms of just his working relationship with you is, the fortnightly calls that he has, and definitely the relationship that he has with you is more of a mentor-mentee relationship rather than a investor and kind of board member relationship, which, from a founder perspective can be absolutely invaluable. One of the more challenging parts for a founder can be, making sure, as we've spoken about earlier, in terms of bringing the right people on. And there's often kind of talk in terms of the due diligence process that investors take in the founders and the companies that they're going to invest in. Again, any advice for founders in terms of their own due diligence process to make sure that, investors or advisors that they're surrounding themselves with are the right people? What are questions or they should ask, or what are things that they should be looking for to make sure that there's alignment in vision, and hopefully they'll go on to have a great working relationship?
Yeah, I think that we've got a rule inside the firm that we want to be seen as a coach in the corner, and we don't. Coming back to my comments earlier, the idea, fundamentally in Australia, we have to get to the end of the line where capital is being put ahead of founders, where there is ownership in companies and people continue to sit on the other side of the table of the founders. When you put capital into these journeys, you actually have to get on the same side of the table as the founder. You actually have to help people. There is an abundance of capital around for the great companies, and people who feel like they indulgently feel like they're entitled to the very best deal flow just because they have money will wake up one day and find that they have none. And so that's really important to us to remember. And we treat our founders, as if we were a coach, which is sometimes you get told things that aren't convenient for you, that aren't necessarily what you want to hear, but they've got to come from the right place, and they've got to be, solely with the purpose of helping the company and helping the founder succeed. And so I think that the best thing I could say to founders is try and understand if the people that you are dealing with will actually sit on your side of the table, not because they say that they will, but they have to demonstrate that they will, and they can demonstrate that they can. And then you should get references of portfolio companies, and don't just call the founders that the VCs give you. LinkedIn is available, Twitter is available. Reach out to any founder and find out what the experience has been like. It won't always be great because failure occurs, but you actually have to understand whether people have been supported, good or bad, through their journey. And so I think that it's important that, when you go on a 10-year journey, just like you wouldn't make a rash decision about a marriage, hopefully longer than 10 years, obviously, but, that you really do want to be on the journey with those people, and you do trust that they will have your best interest at heart as a founder. Ultimately, like, we have 8 principles that we run the firm with, and the last one is that in order for us to do well, our founders need to do well, our companies need to do well, and our investors need to do well, and it operates in that order. And so, fundamentally, we have a trickle-down effect where you have to start treating people well, and you have to look after them in order for them to create value. And so I'm glad that I didn't realize that's what Eric had said to you, but I'm glad that he said that, because very much mentor-mentee, very much a sort of coach-athlete type relationship. And it's just good, it's just good to work with good people, right? And over time, they become your friends. And we've got a company right now going through a significant investment process, and the founder and I talk regularly, and that founder's had just an extraordinary roller coaster of emotions building their company, and a lot of up and down, and a lot of false turns, wrong turns into cul-de-sacs, and they've had to go back and try and work out how to continue the growth. And what's transpiring is just crystallization of all their work. And if you have founders who say that they couldn't have done it without you, you're doing a pretty good job. And that's ultimately should be the most satisfying thing about investing in startups.
Absolutely. Al, I feel like I could talk to you all day, but I do know that you've got a hard stop. So final question from me, which is just more around the VC landscape in Australia. And, we've definitely seen, which I think is, has been a net positive from an overall ecosystem perspective of there being a lot more funds, and especially, some of the funds going on to launch substantially larger funds, which generally means that a lot of those funds then go on to provide sort of substantially larger follow-on investments for companies, which has been great, which I think has been a really sort of missing part of the ecosystem as well. But, from a Folklore perspective, I know a really big focus for you, and a continued focus, is that sort of pre-seed and seed, area where you think the biggest sort of opportunity lies. Again, can you sort of elaborate on why that is a focus area for you, and I guess what you're looking for as well?
Yeah. So, I mean, I think it's great for the ecosystem that we've got a far greater diversity of investors being sort of deploying capital at multiple stages. I think that's outstanding. I think there is an unfortunate axiom being developed in the market that the big investors are the only ones that are going to be big over the longer term. I think that's almost certainly not going to be the case if you look at any other funding ecosystem globally. And so it would be healthy for the ecosystem to understand that you have to have scale and size and distribution across a funding environment. We are fortunate to be in Australia and to have superannuation pension ecosystem that can put capital into funds and continue to put capital into funds, but they also need to diversify themselves as well, because we don't operate like US venture capital where they take their capital from endowments and they only, endowments only top themselves up through investment returns. The superannuation scheme in Australia does that, and it has member inflows. So it's constantly growing, and it needs to be able to understand that allocating across the risk spectrum is important. We invest in early stage because, as I said, we think it's better to be allocating significant amounts by doing the due diligence over time and getting to know the very best companies. We think it's important, to back early stage companies, both practically as investors, because if we're good at what we do and we're good at picking early, we can allocate well and actually generate far greater returns than a late stage fund will ever do, and from the same investment. And then what we want to be doing is ultimately supporting this ecosystem. And I think that it would be great to see more investors coming in at a seed stage. That would be fantastic. It's more competition for us, but ultimately it's better for everybody. And the later stage managers all need to understand that a healthy early stage is important for their long-term success too. And that's something investors need to understand as well. I don't think in 5 years' time or 10 years' time, the status quo will be what it is now. I think it will be very, very different. And you just have to go back 15 years in the US to see what the venture ecosystem looked like. And it was extremely different to what it is now. We've had $270 billion of value created over the last 25 years by Australian software companies. We will have at least that, if not multiples of it, in the next 20 to 25 years. And so there is a lot there for everybody to get their fair share. But the number one thing is that all of those companies that will be created over the next 25 years are going to be started from scratch. And so the funding has to be there and the experience has to be there to be able to do that. And so if we can provide that for great companies and have our fair share of success, then I think we will have done our job, but also the ecosystem will be far healthier than what it was 25 years ago.
Absolutely. Exciting times ahead. Al, once again, thank you so much for coming on the show to share your experience and insights. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
You can go to our website, subscribe to monthly updates. You can reach out to anybody on the team. Everybody's got their details available, and don't be shy. We love meeting new founders. We are not judgmental about the journey people are taking. If it works for us, then that's great. But we also want people to have positive experiences. So if it doesn't work for us, at least you should walk away with some insight that helps you make a better decision for your own journey and your own company. So subscribe to monthly updates and reach out to any of the people on the team, and we'd be more than happy to hear from you.
Fantastic. I'll make sure all of those links are in the show notes. Once again, Al, thanks so much for coming on the pod.
Thanks a lot, Rohit. Thanks for having us.
Thanks for listening to episode 152 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.